Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are surging here as President Trump says there is a framework for a Greenland deal. Our very own Jared Blickery standing by with the headlines. Jared.
Thank you. We are seeing stocks surge here. You can see the Dow is up 800 points after a slightly greater loss yesterday. And you can see the intraday price action only minutes ago. We got that announcement, surged to the highs of the day and then beyond. And we are up 1.6% there. But NASDAQ even higher, 1.76%. You can see it was basically flatlining over the lunch hours there. S&P 500, very similar story. But it is the small caps, Russell 2000 and the S&P 600 up over 2% now, and you can still see that it is climbing, and the mid caps as well. S&P 400 up nearly 2%. Importantly, what's going on in the bond market? Bonds are being bought. Buy America trade, Sell America has turned into Buy America. We have the 10-year T-note yield going down. That's because it moves inversely to price. So people are buying bonds. The long-term yields are going down. The 10-year is down 4 basis points to 4.25%. The 30-year down 5 basis points to 4.87%. That was after a kind of precarious rise yesterday that gave stocks some trouble as the 30-year was marching towards that critical 5% level. It is doing the opposite today. So that is a pressure relief valve. US dollar index just barely positive. And we can also see what's going on in some of the risk markets. Here's Bitcoin. Got a reaction in Bitcoin as well. And let's see, going down the line, let's check out with gold. What's happening with gold? Still looking at gains for the day, but gave back almost everything. Still up 0.5%, 47,887. That is good for a record in gold today. Let's check out the sector action in large caps, led by energy up 2.37%. Then you got materials, consumer discretionary, tech, industrials, healthcare, all of those on the top row up almost 2% or more. To the downside, what is doing the least well is staples and utilities and real estate. Those are defensive sectors, so nothing to see, nothing out of the ordinary there. And then if we take a look at small cap sectors, look at that PSEE, that is small oil, that is up 4%, followed by small tech, that is up 3.3%. Really, the small caps are just going gangbusters right now. And inside the NASDAQ 100, you do see a reversal from yesterday. Tesla up 4%. And by the way, a lot of these index values that I'm quoting here, a lot of these returns are the best days in months after the worst days in months that we had yesterday. So a lot of green on the screen here. I'm going to close with the Dow Jones Industrial Average, a couple of red spots, Microsoft, Procter & Gamble, J&J, but for the most part, we're seeing a lot of positive action here. And on that note, I will send it back to you, Josh.
All right, thank you, Jared. Well, stocks shooting to the highs of the day now as President Trump posts on Truth Social there is a framework for a deal with NATO and calling off the tariff threat on Europe. Joining me now, we've got Keith Gangle, Gradient Investments, Senior Portfolio Manager. Keith, it is great to see you because we got a lot of news here, Keith. We had a Trump social media post talking about a framework for a deal with NATO over Greenland. What that means exactly, Keith, not sure. Framework of a deal is, of course, not an actual deal, but importantly, Trump does call off the new tariff threat. Markets love it. I see green everywhere. What do you make of it, Keith?
Yeah, we like it. I mean, obviously, the market's been nervous recently as the geopolitical risks have risen. That's why we saw off yesterday. I think today is just kind of recouping what we lost yesterday. You know, we as investors are looking at company fundamentals. So all the stuff that we're hearing on these geopolitical tensions, one way or the other, what's going to happen with Greenland, what's going to happen with EU tariffs. I think that's a lot of bit of noise, and what we want to look at is company fundamentals. And right now, we're in Q4 earnings season has started, and it looks fairly decent right now.
But let me ask you, Keith, I mean, how do you distinguish? You're seeing these headlines. How do you distinguish as an investor between, okay, this is noise versus, okay, something fundamental and structural has shifted?
Yeah, we look at past, kind of a guide, look at history. I mean, if you look at last year when the tariffs got first announced, April 2nd, Liberation Day, markets sold off pretty aggressively, down 20%. Again, what we were doing is looking at the company fundamentals. We think that was a buying opportunity. It certainly proved to be because the S&P then rolls the next 40% on those lows. Now we're starting to get noise again, whether it's Venezuela, EU tariffs, Greenland. We don't know what's going to happen there. I don't think anybody really knows what's going to happen. And we don't like to invest by news flow. We want to see some corporate fundamental actions. What are companies doing? How are they changing their policy? Do on some concrete evidence, not on these kind of hypotheticals. Who knows what this potential outline agreement is going to be? And again, I think that's what we want to focus on, not just the news flow. And if something does fundamentally change on the news front, we will change our portfolio positioning.
So to your point, Keith, and I agree. I think investors would rather focus more on earnings than headlines and geopolitics. On earnings, Keith, I guess big picture, what have you learned so far during this earnings season? And what are your expectations for profit growth in the year ahead, Keith?
Yeah, last week was the kickoff with earnings season was generally the banks, and they were very healthy. And we had some credit card noise, again, by policy, kind of potential 10% cap. So those were kind of a little bit noisy. But you had like the Morgan Stanleys of the world, Goldman Sachs, phenomenal. They said the economy is resilient. You've heard some reference to the consumer getting a little bit better. You still got this K-shaped economy. People are talking about the higher end doing better, the lower end not so well. But we have, these tax cuts that are going to get in place for this year. I think there's a better spot for that low end consumer. So I think that can help alleviate the pressure on that bottom end consumer, which will be a very healthy thing for the stock market as that cohort can participate in the markets as well.
How much good news do you think, Keith, though, is priced in with this sort of earnings picture you're outlining?
Oh, I think quite a bit. If you go back the last 3 years in the S&P, we're up 26%, 25%. Last year, 18%. So a lot of good things. But when you take a step back and look at all the things that are going forward still, the one thing I'll point out to, the two things would be earnings growth. This year is expected to be 14%. That's an eye-popping number. If you go back the last, couple of decades, if you can get that 5 to 7, that's kind of the sweet spot for earnings growth rate. That's a good, healthy backdrop. But we did 11% in 2000 or last year in 2025, excuse me. And if we're going to do 14%, that's an acceleration. GDP is accelerating. And lastly, unemployment's around 4.5%, 4.6%. That's still a very healthy number. And again, no one can spend like the U.S. consumer. If the U.S. consumer is working, they have money in their pocket, they will spend, which continues to drive this cycle.
Before we let you go, Keith, let's get to some picks, get to some opportunities. Amazon is a name you like. Why is that a winner in 2026, Keith?
Yeah, it was a lagger of the Mag 7 last year. I think it was the worst performer, actually. I think that's been the valuation is very reasonable. Last quarter at the end of the year or in October, it was a fantastic quarter. Stock popped, and now it's been selling it off. So they have two parts of their business. They have the technology side of the business, which is AWS, which is reaccelerating. And the one area that we like in general is consumer, and half of their business is consumer related. I think they're in a fantastic spot. Multiples are at decades low. I think they're going to reaccelerate. CapEx is behind them. I think this is a good stock to be owning going forward.
What about TJX, Keith? That one's up around 25% already over the past 12 months. Is that still a buy here?
Yeah, that's a buy. Valuation is not cheap, though. He pointed out right. This is one of the different story than Amazon, where Amazon's been a little bit of a laggard. TJ has been a market performer, if not better. Valuation's expensive, but it's a leader in the off-price retailer. So as the consumers are looking for deals, TJX Max is one of the stores that pop up to the top, and consumers will continue to spend there. Even if they get a little more healthy, they still want to find a deal, and that's what you can find at TJX.
Finally, Keith, here's a name we don't talk too much about on this show. Cintas hasn't done much over the past year. It's actually edging in the red here. What moves it higher, Keith, in 2026? Yeah,
all the things I talked about, earnings growth, GDP getting healthier, the consumer spending, more small jobs, small businesses. They're the uniform rental company, the facilities. So as the GDP gets better, you have more people working, you need more laundry done, you need more facilities serviced. And Cintas plays right into that. And again, that's been a laggard relative to some of these other names. But longer term, when you take a step back on this name, this is a compounder, some kind of name we want to be involved in right now. Keith, great to have you on the show today. Thanks for your time and those picks. Thank you.
President Trump's fight with the Federal Reserve making its way to the Supreme Court, with oral arguments taking place in President Trump's bid to fire Fed Governor Lisa Cook. Fed correspondent Jennifer Schonberger was inside the room this morning. Jen.
Good afternoon, Josh. Supreme Court justices expressed skepticism over the Trump administration's legal arguments to fire Federal Reserve Governor Lisa Cook, cautioning that watering down a key statute could have wide-ranging ripple effects, not just for the independence of the central bank, but for government appointees at large. Over the course of 2 hours of oral arguments, the justices signaled their intent through their questions to protect the independence of the central bank from political interference. Now, the question before the court today was, may the president remove a member of the Federal Reserve for alleged mortgage fraud before she came to office and without providing her an opportunity to respond to the allegation? Section 10 of the Federal Reserve Act states that each member of the board shall hold office for 14 years unless sooner removed for cause by the president. The statute does not detail what exactly constitutes for cause. That term has been interpreted in legal rulings to mean inefficiency, neglect of duty, or malfeasance. Those two words were dissected in numerous instances during today's oral arguments. Conservative Justice Brett Kavanaugh, who was nominated by President Trump during his first term, noted that, quote, a low bar for cause would weaken, if not shatter, independence of the Fed. Now, Solicitor General John Sauer disagreed with that, saying that there needs to be a balance between for cause and the ability of the president to remove a member of the Fed board, though he acknowledged Congress's intent by using those words to maintain independence of the central bank. Now, Kavanaugh took that a step further, saying that watering down for cause further, he posited, could translate and ripple to other government employees, or government appointees, I should say. He invoked the notion of whoever the next president is, if that is a Democrat, then that person could use for cause to get rid of all of the prior appointees. Kavanaugh saying, quote, we have to be aware of what we're doing and the consequences for the government. Now, another conservative justice on the court, Amy Coney Barrett, who was also nominated by President Trump, raised concerns from amicus briefs from economists who, she said, told them that if we were to grant the president his stay, that could trigger a recession. Barrett noted that if there is a risk of recession, there is a risk of caution on the part of the court. Sauer, for his part, noted that even after the president announced his intent on Truth Social to remove Cook, that the market did rally in the responding 3 days. Governor Cook's lawyer, Paul Clement, argued that the allegations at most amount to a, quote, inadvertent mistake. Now, while the justices did seem to express concern about the president firing Cook, there didn't seem to coalesce around what to actually do about it. In fact, putting questions to Lisa Cook's lawyer, Clement, about how to resolve this. Now, attending today's oral arguments were Fed Chair Jay Powell and his wife, along with Federal Reserve Governor Michael Barr and former Fed Chair Ben Bernanke, who all attended to stand in solidarity with Lisa Cook. Josh.
Great stuff as always. Thank you, Jen. Well, coming up, Caterpillar stock is trading near all-time highs as the equipment company becomes a surprise beneficiary of the AI trade. And to zero in on why next on Market Domination. JP Morgan Chase CEO Jamie Dimon not divulging much on his views of the Trump administration. Dimon refusing to comment on his thoughts regarding Trump's foreign policy and its impact on the U.S.
When I talk to the press, they never asked me to comment on everything that Biden did. And I think he did some terrible things both domestically and in foreign policy. Do I agree with everything the Trump administration? Of course not.
The CEO, however, capping off his fireside chat by declaring himself a globalist. And here with more about Yahoo Finance's David Holland. Maybe start there, David. Globalist. Now, we know that's not a word that goes over very well at the White House. So was that a joke by Dimon? What did he mean by that?
Well, yeah, Josh, we don't really know. He said it at the very tail end, and he was very clearly asked several times throughout the interview to express his opinions on the foreign and domestic policy of the Trump administration. And Dimon is sort of known as this outspoken CEO who says whatever he thinks and believes. But at the same time, obviously, there's this whole side of corporate America, this conversation about how they have to sort of dance with the Trump administration going on. And between all of that, he kind of just boiled it down to a soundbite of sort of summing up what he thought. And obviously, he's also at this conference in Davos, Switzerland, which is sort of known as, I think in his words, he said where, the global intellectual elite gather every year. So he kind of boiled that all in and say, I'm a globalist. So we don't really know what to make of it, but it kind of conveys kind of the moment of it all, if that makes sense.
What about this? Let me switch gears. This debanking controversy that Trump has raised against JP Morgan. Explain that for us. What's going on there?
Right. So at last year's Davos conference, he actually surprisingly brought up this topic when he was being interviewed by Bank of America CEO Brian Moynihan. And since then, it's taken off. There's been an executive order that's related to regulators looking into themselves and also big banks into whether they debank customers. Over the weekend, though, we got a Truth Social post from the president where he said he would be suing JP Morgan in the coming 2 weeks over what them personally debanking him. Now he's actually already, the Trump organization has actually sued Capital One on this very thing back in April of last year, and he's also accused a number of big banks of doing this. And it all goes to what happened to the Trump organization and himself as far as his banking relationships went after the January 6th protests.
I would assume, by the way, Trump also, of course, calling the cap credit card rates at 10%. I would assume Diamond got asked about that.
He did, yeah. And what he said was not so different from what was said last week by him and other bank CEOs. He said it would be an economic disaster, or I think he said disastrous economically. And so that has been what the banking industry has been saying about this. What was more interesting actually was in Trump's speech later today, we heard him say that he would be calling Congress to pass legislation around the cap. Now, that's kind of interesting because it's been seen, this has been a topic, credit card caps has been a topic of interest for quite a while, and a bill has never really gotten traction. So it's kind of seen as the less scary thing for banks as far as like what it means for their margins.
As a guy who covers this sector so closely, how would you just generally characterize the relationship right now between Trump and just big U.S. banks? Because as you're noting here, he's been throwing some haymakers.
Yeah, I mean, with just Diamond and Trump alone, it's been a very complicated relationship over the years.
Complicated, diplomatic way of putting it.
A little bit of a roller coaster, but I think for the big banks in general, you could kind of say that it's a number of carrots and then a couple sticks, and sort of that's kind of what we've seen in terms of this huge deregulatory agenda the administration's pushing that has been very good for big banks in terms of them being able to put capital into other things. But then occasionally there's like the debanking issue, as well as like the fact that the Trump administration is kind of expanding having regulators expand how much charters can be given out, what the definition of a bank is. So a lot of that is threatening to them. So it's pretty complicated.
Complicated, a lot of cross currents. David, thank you, sir. Appreciate it. Well, industrial companies are starting to reap the benefits of the AI boom, including Caterpillar, whose stock has powered to a new high in recent weeks. Company's market cap hovering near $300 billion. But how much will AI help with the heavy lifting in industrials remains to be seen. Joining me now, we got Brian Sponheimer, portfolio manager at Gabelli Funds. Brian, it's great to see you. Maybe start here, Brian, kind of just at a higher level, because I'm sure, listen, a lot of investors, a lot of viewers, when they think of AI, Brian, they think chips, they think the great data center build out. Can you just start by kind of connecting the dots to Caterpillar and how exactly Caterpillar fits into this broader great AI story?
Absolutely, Josh. Great to see you. So look, when people think about AI, just like you mentioned, they think about software, they think about chips, cloud companies, NVIDIA. But I think what often gets overlooked is that AI is really, it's an industrial story. None of this works without power, and that power needs to be reliable. So we're talking about physical infrastructure that's really required for this next wave of AI and tech generation. So, AI workloads are very power intensive. The data centers that are driving this AI, they need to operate with pretty much near perfect uptime. So where Caterpillar comes in as a supplier of diesel and gas generators, they really act as the last line of defense for when the grid fails. And, we're talking about N1 and N2 redundancy, meaning zero failure and zero tolerance for any hiccups in uptime. So, that's one of the areas, and there are several others, but it's one of the reasons why we've seen CAT shares drive from $300 in April to over $640 today.
So in plain English, Brian, is it fair to say, and just correct me if I have this wrong, that what Caterpillar, what they're doing is they're making and selling the equipment that's keeping those AI data centers up and running?
That's right. So as this data center rollout has happened on a global basis, but really in the U.S., it's created structural demand for industrial grade power solutions. And no company is really as well situated to drive that supply than Caterpillar. And so, when we think about where compute is going, the power demand is really the bottleneck here. And so who's going to be there to supply that? It's CAT.
If I'm an investor, though, then in Caterpillar, how exposed am I to this great AI data center build out, Brian? I mean, what does happen if that build out slows?
Well, I think you also need to remember that Caterpillar is a great company, and just from how well they operate really across a number of industrial verticals, whether it's energy and transport, whether it's within construction industries, which I think are set to turn after a multi-year period where Caterpillar had to take considerable inventory out of their dealers. So that's really primed for an uptick there. And when you think about CAT, the one thing that you don't think about all the time is the service attach. And so there's this embedded base of machinery that they do just an absolutely fantastic job of servicing on a daily basis. And those contracts create recurring revenue at high margins. So it mitigates some of the cyclicality and some of the risk that you might think would be there in the event that the data center build out isn't quite as robust as many bulls are anticipating.
Brian, the stock has enjoyed this strong move. It's up about 60% here over the past 12 months. The street fairly divided, maybe not too surprising after a move like that. I see 14 buys and 12 holds, 1 sell. Is Caterpillar still a buy here at these levels, Brian?
Yeah, I think what's really interesting, and going back to April, that estimates for CAT really haven't moved in conjunction with the move in share prices. So what are you talking about? You're talking about valuation multiples expanding, and that's really a function of two things: it's confidence and it's interest rates. And so rates have moved somewhat, but you're really talking about about confidence and where they're headed. So you're looking at this year, $19 in earnings for 2025, but a line of sight potentially to upwards of $30 to $35 in earnings. With shares at $640, it's probably priced for perfection. Probably look for a pullback before getting really excited about it. But the fact of the matter is that there's an inevitability to this industry 4.0, this Internet of Things that is really going to be driven by AI. It's going to be driven by companies like CAT that invest heavily in AI in their own respect. Things like predictive maintenance are going to be incredibly important, helping manufacturing companies address workforce solution issues. Caterpillar will be right there as well. So, they're pretty optimally situated for a number of areas where we think that demand is going to be inevitable for their machines.
Final question, Brian. I'm just curious how you think about Caterpillar's competitive edge here in this AI story, because I would imagine its peers, its rivals, Brian, other industrials, they must be leveraging AI as well.
Sure. I think, going back to the point about service, that is where Caterpillar excels. And so when you can combine uptime plus service reliability, that's how you build moats in businesses like this. And it's how companies like Caterpillar and John Deere and a host of others have really excelled within the industrial space, and why they continue to gain share, they continue to grow in excess of peers, and they continue to be able to invest in technology that helps them make those moats deeper and wider.
Brian, thanks for your time today. As always, appreciate it.
I appreciate it. Thank you very much.
Coming up, we bring you some of the top trending tickers on Yahoo Finance. That's next on Market Domination. President Trump using his speech in Davos to highlight housing policy and the push and pull between prospective home buyers and homeowners.
And I don't want to do anything that's going to hurt the value of people that own a house. Now, if I want to really crush the housing market, I could do that so fast and people could buy houses, but you would destroy a lot of people that already have houses.
The president's remarks come amid his efforts to address affordability concerns. And here to break it all down for us is Yahoo Finance's Claire Boston. Claire, what do you make of it?
Hi, Josh. So we really did see Trump highlight this issue in the housing market where first-time buyers and people who already own homes want different things. Homeowners want their values to stay really high, but those first-time buyers or people trying to get in the market who are currently renting, they need prices to be lower. And so what we're seeing Trump really try to do is these demand side things that would induce demand for people who don't already own, but wouldn't really add to housing supply, which might hurt homeowners. And so he talked a little bit about some of the policies he's already enacted. That includes this executive order to ban institutional investors, as well as this $200 billion mortgage bond buying program with Fannie Mae and Freddie Mac. He also took the time to throw a little bit of shade at Jerome Powell and say that he thinks that interest rates across the board need to be lower and that he's really excited to announce a new Fed chair very soon.
And Claire, how do Trump's policies impact rates exactly? Walk us through that.
Yeah, so it's kind of a complicated relationship. In general, what the president does not really impact rates. However, Trump's bond buying announcement did push mortgage rates lower because it boosted mortgage-backed securities demand. But then the whole Greenland thing yesterday and today really changed the games, and the markets got really scared. We saw Treasury yields rise, and those have a really close relationship with mortgage rates. So we are now back to mortgage rates at around 6.2%, which is where we were a few weeks ago, and really undid the entire drop that we were seeing in the past couple weeks. So it's really kind of unclear times, and we don't really know where mortgage rates are going to go next. But this Greenland policy is having a big impact.
And finally, Claire, where are we right now? As somebody who tracks all this so closely, with the housing market recovery, Claire, how would you characterize where we're at?
Right. We are in this very, very fragile state in the market. And we got some new data today on what we call pending home sales. And these are people who sign contracts for a home sale. And the pending home sale numbers were quite poor. They were down 9.3% in December from a month earlier. And I think that that really emphasizes that we are just in a very fragile state in this market. And it's really touch and go as to whether we're going to have a better spring. We were also down 3% year over year. It's just really hard for people to afford to buy a home, think that they want to pull the trigger now, given general economic uncertainty. And some economists now seeing these latest numbers are wondering, will we see any sort of uptick this coming year? So we'll have to see.
Claire, great to have you on your show. Thank you.
Thanks, Josh.
Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here with a look at Travelers, Moderna, and Lucid. We're going to start here with Travelers, the insurance company, reporting better than expected fourth quarter earnings. Brooke, so okay, the insurance company, they delivered core EPS for Q4. That did beat what most analysts were looking for. Most analysts, it looks like, actually do have a hold on this one. What do you see?
Yeah, most analysts on the sidelines here, about 17 holds, 9 buys, and 3 sell ratings on the street when it comes to the Travelers. If you see the stock reaction today, up about 1%. And I was actually reading a note from Evercore this afternoon that said that they were a little bit surprised about the stock reaction, said that they're a little bit surprised that the stock isn't acting better despite solid underwriting and pricing that was in line with whispers. Citi having a bit of an optimistic take on this, saying let the good times roll. They said the Travelers fourth quarter highlighted the tailwinds of the past several years continue to drive strong results. And so wait and see story here. This stock over the past year is up about 14%, getting a bit more momentum today.
And next up, a look at shares of Moderna and Merck following 5-year data results for their personalized cancer vaccine. So this one apparently reading up on it a bit, Brooke. So this is a personalized cancer treatment. It was developed by Moderna and Merck, did help prevent the recurrence, they say, of high-risk skin cancer after 5 years. Yeah,
essentially also saying that this cancer vaccine cut melanoma relapse or death risk by 49%. So definitely momentum there, and Wall Street certainly reacting to that. Merck stock up about 1.6%, Moderna stock up more than 14%. And another note out from Goldman Sachs saying that this sort of is a critical step for Moderna Moderna to move away from just that COVID focus that they had over a few years ago and really lead into this diversified mRNA therapeutics platform. Definitely momentum here, especially for Moderna, moving higher this today as we make our way towards the close, up about 36% over the past year. But if you take a look over the past month alone, we've seen a lot of that momentum up about 45%.
And finally, Lucid deepens its collaboration with Rockwell Automation to help power its EV manufacturing facility in Saudi Arabia. Reading up here, this was the biggest intraday move here since July, actually. We know this one's volatile. I mean, it's down about 60%. I'm just looking over the past 12 months, though higher today.
Yeah, down about 60% of the last 6 months, down about in line with that, down about 60% of the past year. And really this momentum could be something here. So that definitely has Wall Street excited, up about 18% during today's trading session. What I'm reading on the street is that there's this optimism that this collaboration could really help Lucid scale its manufacturing capabilities. That's also in line with this Saudi Vision 2030. Essentially, that's something that the Saudi government unveiled back in April of 2016 to increase diversification economically, socially, and culturally within Saudi Arabia. Definitely investors keeping a close eye on what exactly this means for production timelines, delivery trends for Lucid, but definitely still it seems like a lot to prove on the street here.
All right, thank you, Brooke. Well, shares of pharmaceutical giant Johnson & Johnson lower despite topping earnings expectations in its fourth quarter. Guggenheim Securities analyst Vamil Divan joined Market Catalyst this morning to discuss investor reaction to those results.
So I think it might be a couple of things. I do think the numbers were good. I think the guidance was good. Maybe there's a little bit of expectations for a higher earnings guidance for 2026. Always tough to predict exactly what investors are looking for there, but maybe that was a little bit soft, but still I think fine. There also was this ruling that came out last night related to the talc litigation that's been ongoing for the company for many years now, which suggests that this process is going to continue, and a number of cases that I think Johnson & Johnson was hoping to have thrown out are not likely to be thrown out now, and this process continues. So I think that may also be a little bit of a headwind, just as people digest that news. I don't think it's a fundamental issue or concern for the company, but the stock performed very well last year, one of the best performers in the group. I think maybe it's just giving a little bit of that back as people may be a little disappointed on that headline, and again on the guidance not being as high as people maybe hoped.
And the company said that the sort of deal that they made with the administration over drug pricing, it sounded like what cost them in the pennies, I guess, for earnings per share. Or how are you estimating that out, and what effect could we see going forward for that?
Yeah, so I think similar to other companies that have done these deals, they're all saying it's sort of a modest impact, nothing too dramatic, but it is having a little bit of an impact on the top line and the bottom line as they're giving up a little bit on price to the U.S. As part of those agreements. So I don't think it fundamentally is changing the outlook for any of our companies, honestly. I think we also wonder, are these all firmly in place? We think they are, but as we see with this administration, things can go back and forth a little bit. So, but I think if they stay the way they are, I think it's manageable. And really fundamentally why we upgraded the stock last year is the underlying new product story that they have here. A lot of exciting products. You mentioned some in oncology that perform well this quarter. Also in immunology, they have a number of attractive assets. So I think it's that new sort of product story, this accelerating growth we're seeing, that gets us very excited, even if that agreement maybe trims a little bit off the top line and the bottom line.
And as you mentioned, I mean, the cancer franchise seems to have performed well in the quarter. They have 6 cancer drugs that saw pretty decent sized increases. I mean, as you know, the challenge for many of these legacy pharmaceutical makers is they've got patent protection rolling off. They have to come up with a new pipeline. How would you situate, or what grade would you give Johnson & Johnson versus some of its competitors in terms of that transition?
Yeah, so a lot of that is just timing. So they went through a very tough period over the last couple of years where they lost patent protection for a key immunology product called Stelara, which is a $10 billion product. And they're in the middle of losing patent protection for a couple other smaller products this year and next year. But they are really the start of this new cycle of products that I was mentioning that just had great data over the last couple of years. One that launched last year, they got approval for a new formulation of a lung cancer product at the very end of last year. We're expecting an approval in immunology in the coming months. So that's what I think gets us very excited. They're on the right side of this cycle and at the beginning stages of a new product cycle coming through this year. So that's why I think they've navigated the IP issues that they had. That's why we were neutral on the stock until the middle of last year. But they showed that they could navigate that, delivered good new data for exciting new products, and are now launching those. I think they got several exciting years ahead of them, really almost to the end of the decade. See a nice period of growth for them.
So Vama, given that we've seen a little bit of a pullback today on some of the things that you described, and you've got that buy rate and that $227 price target, what milestones do they need to hit this year to keep the momentum going from last year?
Yes, I think it's really going to be a lot about commercial execution this year after a lot of good data over the last couple of years. So I mentioned there's a new product in immunology for psoriasis that we think might get approved by March. In April, there is a bladder cancer product they got approval for last year, but the reimbursement part of that should get sorted out by April. So I think the uptake of those two products, one is called Icotai, the other one Inlexo, what we see from those products in the second quarter, third quarter, fourth quarter, I think will be very important, along with obviously continued progress with Darzalex and Tremfya and some of their core products that are already doing quite well. So if they can show that they can launch these new products well, I think more people come around to the fact that this is a new era for this company and a new product story that's just starting.
Vama, thank you so much. Appreciate it.
Yeah, thank you.
Coming up, a year out from DeepSeek, we take a look at how the U.S.-China AI race is shaping up. That's next on Market Domination. It's been about a year since Chinese AI company DeepSeek released an open source model that sent big tech stocks plunging as China seemed to be gaining on the U.S. in AI advancement.
Was it a year ago DeepSeek came out? Last year. And DeepSeek was, a lot of people were quite concerned about it. Frankly, DeepSeek was a huge event for most of the industries, most of the companies around the world, because it's the world's first open reasoning model.
Today, fears still haven't completely abated, of course. Microsoft's Brad Smith recently warning that China is winning the AI race outside of the U.S., saying, quote, they benefit from subsidies that enable them to basically undercut American companies based on price. Joining me now on the state of the AI war is Chris McGuire, Counsel on Foreign Relations, Senior Fellow for China and Emerging Technologies. Chris, it's great to have you. Maybe we'll start there on those comments that Microsoft's Brad Smith made to the FT, Chris, because they got a lot of attention. Basically, he was saying, listen, China is winning the AI race, he says, outside of the West. He talked about rapid adoption of China's DeepSeek technology in emerging markets like Africa. He said here, we have to recognize that right now, unlike a year ago, China has an open source model and increasingly more than one that is competitive. I guess big picture, Chris, do you sort of agree with those comments from Brad Smith about this kind of Chinese AI momentum that he's seeing and highlighting?
I don't agree that I wouldn't characterize it the same way that Brad did. I think if you actually look at Microsoft's report, what it shows is that DeepSeek, the places where DeepSeek has a lot of market share is mostly Russia, Belarus, China, Cuba, Syria. It's countries where our companies are obviously not competing. In the countries where our companies are competing, we generally have, on Microsoft report, 90 to 95% market share. So I agree with the idea that the Chinese are moving quickly in AI and are a significant competitor, but I don't think that their market penetration is quite as sophisticated or advanced as Microsoft painted it out to be in the comments.
In that same interview, it was interesting, Chris. Brad Smith talked about the role of the Chinese government there. In your opinion, should the American government, Chris, should they be sort of subsidizing the AI industry here the way China is?
I think that we need to provide certain support to certain elements of the industry that require kind of long-term capital, particularly semiconductor manufacturing, advanced packaging, things like that, where I think our financial markets, it's a little bit harder to provide that kind of long-term predictive capital. But I think when you look at like data center construction, when you look at the AI labs, like there is all sorts of private capital for this already. And that is because we have such deep and liquid capital markets that is a huge benefit of our system. I think the Chinese system is the state-backed system, so therefore they're kind of forced to push money into this in order to kind of drive these industries. But the U.S. economy is mostly being driven right now by AI investment. in data centers, predominantly for AI inference, that is all being privately financed. So there might be a point when the scaling laws, because of the scaling laws, the data centers get so large that they require financing from the government. I don't think that we're there right now, and that's something we could consider down the road.
Also interesting, your take on this, Chris. American chip companies, the NVIDIAs, the AMD, selling advanced AI chips to China, and whether that should be permitted. I don't know if you saw this. Anthropic CEO talking to Bloomberg, he said selling advanced AI chips to China, that was a mistake. Says, I think this is crazy. Says it's a bit like selling nuclear weapons to North Korea. What do you make of those comments? Do you agree, Chris? Should we be, in fact, maintaining restrictions on these kind of AI chip exports?
Yeah, I did see those comments, and I think it's a fair characterization. Look, I think that the U.S. restrictions on AI chip exports to China are the single biggest differentiator between the United States and China in AI. If you look at the rest of the AI stack, data, talent, algorithms, electricity generation, applications, China is as good or better than us. But the fact is, on chips and AI compute and hardware, we have a massive lead. And given this is the single most important input into sophisticated AI models, and the compute needs of these models is radically increasing, this is both the core to our advantage and also the single biggest thing that the Chinese need to catch up. And there is significant bipartisan concern inside Washington on the plan of selling AI chip sales to China. And to see that, actually, you can look at the House Foreign Affairs Committee just today, which voted out a bipartisan bill 42-2 that would put significant restrictions on AI chip sales to China, put congressional oversight on them in the same way that they oversee arms sales, and also ban the export of more advanced chips, Blackwell chips or the equivalents from other companies, for the next 2 years. So we'll see where that legislation goes. But the fact is, that is showing that I think while the administration is pursuing a policy of selling AI chips to China, I'm not sure that that is necessarily at a stable equilibrium right now. And there is real concern from both sides of the aisle that this might not be in the U.S. national interest.
What about, Chris, and I'm simplifying the argument, but the counter argument, it goes something like this. Well, we should allow these AI chip sales to China because we want the Chinese consumer, Chinese enterprise, we want to get them loyal and locked in and committed to American tech. What do you think about that, Chris?
Yeah, so a couple things I'd say in response. The first is that the Chinese government is never going to allow their companies to get addicted to U.S. tech, right? They will make sure that every AI chip in China gets sold, and they are going to prioritize semiconductor production. You can see this both in their determination in indigenizing semiconductor production and just their historical reluctance to accepting U.S. dominance or Western reliance on the West for any strategic technology, particularly semiconductors. The other thing I'd say is that this idea that the chips are sticky and there's this addiction, I think doesn't really stand up to scrutiny. And the reason that you know that is you can actually look at all the AI labs, and every single one of them is pursuing now training or running models on non-NVIDIA chips. So what that shows is actually with a lot of capital and a lot of dedication, you actually can switch ecosystems. And the Chinese government, if nothing else, has a lot of capital and a lot of dedication, and they'd be able to switch off as soon as they're able to indigenize as well.
Finally, Chris, as we talk about this great AI trade and trend and how it evolves from here, you talk about how we could be entering, you say, AI takeoff. What does that mean exactly, Chris?
Yeah, I think that we have to grapple with the fact that AI advancements are happening very, very quickly, and potentially more quickly than I think a lot of people appreciate. I think we are seeing evidence of what's called recursive self-improvement of AI systems, which means AI systems that are training the next generation of AI systems. And this isn't to say, I think a lot of people confuse this with ideas of AGI or something like that. It's not that. It's more just the idea that the rate of advancement of AI models is increasing is increasing at an accelerating rate. So I think we are going to see more and more powerful models in the near future. And you're seeing also like massive investment from US companies that is also facilitating that. So the implications of that are significant. It means that this is going to be an even bigger driver of the market, an even bigger driver of national security, and probably a big, even more important factor in kind of geopolitics, international relations. I think that we're going to have to adapt to policies that are a little more uncomfortable faster than we currently are.
Chris, big, important topic. Thank you so much for helping us think through it.
Greatly appreciate you having me.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.